Appreciate your time here on CNBC TV18. Amit Jeswani is with us, founder and CIO at Stallion Asset. Amit, good to have you with us here. Thank you very much for your time. Let's just start with some numbers. I don't know if you're tracking these, which have come out. Craftsman Auto, a lot of mutual funds own it, numbers came, there was a bit of a margin miss. I don't know if you saw the numbers, if you have any thoughts on this one. These chemical companies which are reporting as we speak, Petronet reported just a while back. Anything, you own, if you own any of them or have a view, your thoughts?
So Prashant, we don't own any of these companies. Good afternoon, Prashant. Thank you so much, first of all, for having me on your show. We don't own these stocks in our portfolio. It wouldn't be right for me to comment because I don't track them so closely. But the capex cycle remains very strong. Like at least the numbers which are coming out, be it for power transmission companies, automation companies, these numbers are very, very, very strong. But I've not gone very deep in them.
Anything out of your portfolio companies which you want to talk about where numbers surprised you, Amit?
We're like what we've done is last one quarter we've added some capital marketplace. The last time I came on your show, I spoke about Angel One that we've added to our portfolio. Yeah. This quarter we've added MCX in our portfolio. So this is a place where we strongly believe that these are not recommendations, of course, and me, my family, everyone has, my clients have vested interest in whatever I speak. But MCX is what we've added to the portfolio. We expect this is a 10,000 crore monopoly in exchanges. Options started 2 years back in MCX. The revenues used to be 8 crores for the first quarter. MCX had done 8 to 10 crores of revenues. This quarter, we're expecting 86 crores of revenues. Options for MCX is now bigger than futures. In fact, this quarter is going to be way bigger, like 150% bigger than the futures market. So you have a massive change. The stock has made a 10-year high. It's crossed its 2013 levels. There's a massive change which is happening. And we are expecting 400-500 crores of PAT in FY25. And hopefully, and right now the market cap's around 10,000-11,000 crores. If the story plays out, we should end up making very decent sums of money. We're looking at very large changes, Prashant. That's how we try to create alphas.
Did you book profits in the quarter gone by in any stock in your portfolio?
This quarter, we're expecting. So this quarter has been a very weak quarter for consumer-facing companies in general. We're looking, our numbers have not come out so well. Like if you look at like this dip, what we've been doing is, Reema, we've just been swapping stocks within our portfolio. We're going higher the quality curve, higher the growth curve, because we don't believe this is a crash of sorts. We believe this is a bull market correction, and we need to up our game, at least on the alpha creation side. So what we've done, example, even if you look at any sector, let's take an example of FMCG for that matter. ITC reported 4% revenue growth. HUL reported 3% revenue growth. You had Varun Beverages, which corrected 10-15% a few days back from its highs, and you have guaranteed double-digit growth because Pepsi has already said that volume growth will be double-digit in Varun Beverages, and that is where we start looking. It's trading at 55p, ROCs are 28%, reinvesting 100% of cash flows. These are the kind of bets you want to keep swapping in this bear market. Make your portfolio quality very, very, very high. And bear markets, these small corrections about making better portfolio choices. Like today, one of our portfolio company, which is a basmati rice company, came with fabulous numbers. It's at 10p multiple today. It's less than 10p, 5,500 crores market cap. I'm speaking about Dawat. This is not a recommendation, of course, but it came with fabulous numbers. It's now trading at 9 times FY24. So let's see, you've got 20% ROC, 10 times FY24. If we go right, hopefully we should make a lot of money. If we go wrong, we lose some money.
Well, I guess that's the market. That's life, right? Win some, lose some. Amit, I believe you've had a keen eye on a lot of these internet stocks as well, right? Consumer technology, internet, new age, call it what you want. What's the sense on? Some of them have had a pretty good move, for instance, Zomato. What would you buy, if anything, afresh?
Surabhi, we've got Zomato, Policy Bazaar, and Paytm, which are part of our portfolio stocks. We got them broadly 1 year back. They've been decent performers for us. And Paytm should be PAT positive, PAT positive by end of this year. By Q4 FY24, Paytm should be PAT positive. Policy Bazaar will show large profits in the next 3 quarters, starting from this quarter. Zomato already became PAT positive last quarter. So we are fairly bullish on consumer tech. I believe consumer tech and capital marketplace, we are broadly 15% allocation towards consumer tech and 15% allocation towards capital marketplace. These both should lead the next bull market. This is what we feel as of today. Because when these companies, the 3 companies which I spoke about, with them from losses to PAT, typically this is a framework that we use in our for our alphas, and this framework is a very powerful framework. When the entire sector moves from loss to profit, typically you see very large moves, and they are very trending in nature, and that should happen in Paytm. That's what we think should happen. Of course, we have our risk management systems if we go wrong, but you will see PAT positive in all 3 companies in a very big way.
So just to Amit, go back, you bought Daawat. You've owned Daawat for a while, or you bought it recently?
So we got it at 3,000 crores market cap. So right now it's 5,500 crores market cap. So, but today the numbers came good, so we gave bonuses to our promoter. You know, they gave me good numbers, we gave some bonuses. By bonuses, I mean we added some. We salaries and giving bonuses every quarter. You know, every 90 days, if you do well, we'll give you bonuses. If you do badly, we'll cut your salaries.
That's a nice way. That's a nice way to think about it. Usually, when you say bonuses, you know, it's coming from companies. But yeah, that's well put. You know, you know, you own Zomato, you own PB Fintech, you own Paytm, all 3.
Yeah, all 3.
Okay, and there's another company which is not consumer tech, but you know, Mama Earth, which is coming with the issue opens tomorrow. I'm not sure if you've looked at it. They've done the rounds. I'm sure they must have met investors, etc. Any thoughts if you've given it a closer look?
My team's met them. I've not closely looked at it. My team's medium. They're not very bullish. They're not very bearish on it. It's about execution. They've already turned profitable in the first quarter. So if the company, see, typically in consumers, if you grow at 30%, see, there are about 3-4 companies in consumer that used to grow at 30-40%. There used to be a time when DMart used to grow at 30-40% and markets would give it 100 PE. Today, Trent is growing at 40-50% and Trent gets 150 PE. Of course, this is not backed by Radhakrishna Damani, or this is not backed by Tata. So if you, and this is a private equity-led company where promoters own 35%. So the markets will keep it maybe closer to 100 plus minus 20 PE, depending on their execution and what they're doing. But I've not looked very aggressively into it, so not right for me to tell what we will do in Mama Earth, but they've done well. They've scaled up very well. That you have to give it. But we've had very bad experiences in beauty, to be honest. Our largest portfolio loss ever has been, not ever, the second largest portfolio loss has been in Nykaa for us. We lost 1.2% of our portfolio. So that's our second largest loss, and beauty, we are very careful.
I was just going to ask you, because you mentioned those 3 internet companies. I was wondering, so Nykaa's not there. Nykaa's not done too well, but okay. Appreciate your candor on that note. Since we're talking about it, let me just go back to something not as exciting or exotic. Chemicals, we have some numbers and some guidance flashing on our screens right now. UPL, the pain is so evident, right? They've cut their guidance. Not just Indian companies, global chemical companies have been cutting their outlook as well. Do you have any interest in this sector?
See, SRF is the only company we like here. We don't own it right now, but SRF is like the Bajaj Finance of chemicals, according to us. They're doing a 14,000 crore capex. What we love is, should be companies who are reinvesting 100% of operating cash flows at very high ROICs. And that's what SRF has done consistently. Of course, right now the cycle is very bad. See, chemicals move between specialty and bulk chemicals. Like in bull markets, everyone calls every chemical company specialty chemicals. In a bear market, everyone calls every chemical company as bulk chemical company. They are neither specialty nor bulk. They're somewhere in the middle, and you need to back the right promoter. See, think about it. IT went through a down cycle, but you've got stocks like Persistent who are growing, or KPIT, who are making new highs, because that's where the growth has sustained, right? Persistent, after going up 5-7 times, it corrected 30-40%, and now again back to 6,000 levels. So that will happen in the chemical space as well. The lathi charge, where the entire sector corrects, regardless of anything coming, that is now coming to an end in chemicals. That probably one quarter here and there, the companies who start performing well should start seeing money getting allocated there. So that happened in tech also. Like, no one's going to buy Infosys or TCS if they say that we will grow at 0 to 1 or 0 to 2%. Like, India's nominal GDP growth is 14%. And if you grow less than 14%, very tough for asset allocators to you have to be really cheap for asset allocators to even think of looking at you.
That's a new terminology that I learned. Lathi charge, when the entire sector gets derated and the markets do not differentiate in individual stocks, you're calling it lathi charge, but you believe that's coming to an end for chemicals. Just curious, right? You spoke about Nykaa. The bet didn't work out at the value at which you invested in the company. What are you doing now? Are you looking to add some more at lower levels, or have you cut the salaries of employees, as you called it, when they don't deliver?
We cut salaries completely. We fired Nykaa out of our portfolio. We invested in Nykaa at 2,000. We were out by 1,400. So we cannot hold on to our losers.
Okay.
It's not right for asset managers to lose. So we lost 1.2% of our portfolio. We got out. So that's our second largest loss in our portfolio. We have to cut losers. The growth rate tanked from 70-80% to 30%, and for 30% growth you don't end up paying unlimited PE multiples, right? For 70-80% growth, see, in consumer companies, if your growth rate is about 30-40%, let's take an example of Trend, where growth rates are about 30-40%, markets will not bid them down so closely because you don't have alternates. Your alternates are growing at, let's take an example of an HUL or a Nestle, or these guys are trading at 60-70 PE. Even DMart at 18% revenue growth is trading at 100 P. Okay, DMart and Trent are comparable companies, both very good pedigree managements. If DMart at 20% growth, which is below 20, at 18% revenue growth, trades at 80-90 P. See, that's how market looks at it. You will have your trend always at 130-140 P because it's growing at 40-50%. 10% growth rate is for HUL, Nestle, and all these guys, which trade at 60-70-80 P. So that's how you, in consumer stocks, like Cello is coming with an IPO. It's growing at 25% for next 3 years. The market leader. ROCs of 50%. You start looking at consumer companies are valued based on their revenue growth rate.
Sure.
Okay, Amit, interesting conversation. Great speaking with you, and appreciate you joining us here on CNBC-TV18. Speak to you again soon. Thanks very much for a good chat. Thank you. Well, the market